What's up, guys? Ron Rohde back here with a live discussion. I've got Chad Griffiths on the channel today, and we're going to be discussing a really important evolution or a change in the U.S. economic environment, and that is inflation. Chad, what is going on?
I, first of all, like the idea that we both have different backgrounds. So you've got a nice white background. I've got the dark background. I think this is going to be a conversation of polarizing opinions because you and I have chatted about this a lot over the years. And I think inflation is still very problematic. And I don't see any signs in the near future where that's going to go down. And even though the feds are committed at face value, anyways, I'm a skeptic of everything that the feds have to say at the best of times, but they say that they're committed to bringing down inflation. And they're doing that by pulling the lever of interest rates. Well, they've pulled that lever, and now we're seeing bank failures. There's all this cynicism in the market that more banks are going to fail. There's going to be commercial real estate mortgage collapse. I read a stat. There's trillions of dollars of mortgages coming up.
But let me interrupt you there. I hate all of those clickbait headlines because for everybody listening, you have to understand how to filter the news and the information because commercial real estate is not a monolith. It is such a nuanced area. And if you're an investor with your money in specific asset classes in specific markets, you are not subject to the broader commercial real estate market. And it's such a big asset class. It doesn't make sense. In my mind, I always say, yeah, but how much is office? Yeah, but how much is in class C, suburban office or shopping malls? Those asset classes declining, they don't affect you and me. Those properties, the keys in Southern California, Blackstone gave back the keys to two towers there. That doesn't affect you and I. It doesn't affect our lending. It doesn't affect our underwriting. But sorry, I had to correct that because it's something that I see a lot and people are always asking to my reaction. And I say, well, let's dive into the data. What does it actually mean?
Well, let me give a rebuttal to your rebuttal, since this is keying off like a debate here. Yes, agreed. And commercial real estate is broad. And generally speaking, that includes a lot of asset classes that at any given time are going in different directions. Most people would agree that industrial looks a lot more attractive right now than class B or C office. But and this is a big but anytime, so when BlackRock or any of these other big companies, PIMCO is another one that I heard is walking away from some office. Whenever they walk away from it, that's going to put pressure on the capital markets as a whole. So if you're a lender and you've got capital spread out in different areas and you just had to take back a massive asset or a portfolio of assets, and now you have those on your books, you're probably a lot less likely to be interested in lending out to anything else until you at least settle that. So this reminds me of what happened in 2009, where there was still strong asset classes, but the capital markets dried up because everybody, using that cliche term, was pencils down. And even though industrial does look quite attractive right now, if they're being forced to take back these properties on their books, I think that they're just going to take more of a pessimistic view of lending in general, regardless of what the strength of the asset class is.
Sure. And I hear what you're saying is that we may have a nuanced view, but other players in the market, and whether these are broader equity or lenders, debt service, they don't have as much of a nuanced view. They just shut down the whole commercial lending department without discriminating against good assets or not.
Yeah, so I say that's just one point in my column in this debate that we have. We need to almost have a judge to say
That's right.
who's gonna win this debate. There's a saying that I always remember. I think it was William Wrigley. Maybe it was the junior that said it, that if two people are always in agreement, one of them's unnecessary. So I think that it's healthy to have a little bit of debate going back and
No, we
forth.
have to because look, we're different people. We make different investment choices, and I think that's what we're going to talk about is really the impacts of inflation. We are seeing a lot of signs that inflation is coming down, and people just do the aggregate average, but it doesn't really reflect reality. So we'll just jump into it again. Uh, multifamily rents are coming down, and even if they've come back up, we know that year or month after month of declines, it takes a much bigger raise to get you back to that original basis. So we're starting to see some multifamily operators that are in distress. There was a huge foreclosure in Houston, a $230 million portfolio. That to me is going to put more downward pressure on rents, which in turn turns down inflation, and as well as the supply side, right? So you talked about the Fed and the levers that they have on demand, but supply is busting their butts. They're working 24/7 to ship more goods. We've got trucking, we've got all the ports working at whatever capacity they are. That backlog of inventory is catching up, and that's going to put downward pressure on pricing, which is going to bring inflation down to normal amounts.
I would agree, and I'd concede with you on the point that it will have an impact of bringing down inflation. But the problem is it's such a large machine with so many gears and cogs in there that it doesn't. Picture a big Maersk shipping container as an analogy. That boat, if you want to turn it around, that's not a quick turn. It's going to be a lot of backing and forth, and that's going to take a long time to change the trajectory of that ship. And I think that that's what we're facing right now. And I think that's the biggest problem that the Feds have, is that they started injecting money in 2020 at an unbelievable pace. I saw that in 2020, the US alone added $3.3 trillion to the money supply, which was about 20% of the money supply. So you could say, well, it's not a closed system, so you can't put 20% in and expect there to be 20% inflation. But in essence, every other every other government was injecting similar types of money
True,
supply.
true,
So you're
true.
flush with global new currency. That currency has to find a home. I think that there's still a lot of the public that still has a lot of appetite to spend money on things. They perhaps are slowing down, if for no other reason than the sensationalism we're seeing in the media about a recession forthcoming. But it's going to take a while for all that to trickle through the system. Even shipping containers. At the peak, it was $25,000, $30,000 to bring in a shipping container from China. That's sub $3,000 right now. But
Right.
until that all trickles through to the system, it's still going to take a while. And that's why I think the Feds probably will overcorrect this. They'll raise interest rates too high, and then we probably will see more of an economic downturn than they were hoping for, at least.
So then they will eventually sap demand enough to bring down inflation. And I guess again, my point throughout all of this is I think if we are a container ship, the demand side is the boat captain. Okay. So he's controlling the motor and he throws it in reverse, and they're trying and they're spinning as fast as they can. There's not going to be any net effect, maybe slowing the boat down a little bit, but not turning. The supply side, those people are like the ocean in the water pushing as a current, and they're providing this every day a little bit more animal spirits. All the entrepreneurs are busting their butt to produce product to get it over to meet that demand, especially at the inflated prices. But that is something that's working in conjunction with the motor, with the Fed trying to turn it around. And eventually that's going to be a very powerful system to bring pricing back down, because everybody is working globally to deliver more product. And so you've got the Fed that is overcorrecting, but I think that supply side is going to win the day in terms of bringing inflation under control, at least to the extent that supply side can. I mean, in Texas, right? I'm based in Dallas. We still have buyers or builders that are buying land. And it's really interesting on what they're looking for. Certainly they're pickier. They're cutting their pricing and they're not building anything, but they are still buying because their overall sentiment of the economy still has a ton of pent-up buyer demand.
Yeah, going back to the analogy of the container ship, because I think this is appropriate. I wouldn't trust Jay Powell to not sink that ship, let alone determine what direction it should be going. I just have very little faith in their ability. And this shows they printed so much money, but didn't raise interest rates once throughout the pandemic. I have very little faith in their ability to successfully navigate through this, other than they're committed to trying to turn the ship around. Where I would say this has the most implications and is the most problematic for people is that inflation is going to hit different people in different ways, and it's
Absolutely.
not uniform. We're not going to see inflation go from 8% to 2%, their targeted mark, and not see a lot of distortion along the way. And a good example would be food prices. I'm in a fortunate position where if food prices go up 50%, it's not going to materially affect my family's situation as much as it would someone that's on fixed income or low income, where that could be materially devastating to somebody like that. I'm blessed and fortunate that that doesn't affect me.
See,
But
not me
conversely,
though. When food prices go up, I tell my wife, we're not eating any bacon. When I am very
start your own
sensitive
garden.
to complementary proteins or anything, orange prices go up, and I'm sorry, kids, we're not eating any oranges. We're sticking to apples. And yeah, I agree with you. I'm very sensitive, but again, we're fortunate. I go to the grocery store and we have a lot of choices, so
Mhm.
it's typically isolated. Though, would you agree with that? Though it's the prices are elevated as a whole, but it's weird. It's sometimes it's individual things. Chicken wings go up, but the steak price hasn't necessarily gone up the same percentage.
And this is getting out of my lane where I am not an economist and I can't. Apples and oranges, that's a great comparison right there. Speaking of that, it's very difficult for me to try and prognosticate or even fathom what's going to happen in these markets. I guess going to my point of trying to make on it is that food is an inconvenience for me. That takes money out of our pocketbook if food prices go up. But it's not going to be a crippling for me. If on the other hand, if real estate prices start declining at an unsustainable pace, going the opposite of rising inflation, start seeing deflation, that's problematic because of where I've got my investments stored and personal guarantees that I've put out there. That's distressing in a different way than someone that would be happy if food prices went down. So I think that's what is going to be the uncertainty for this next coming year is I first of all have absolutely no idea where anything's going. I all along the way, through the Great Recession, I had no idea what was going to happen. I thought it was going to be much worse, much longer. When COVID came in 2020, I was panicking. I thought it was the end of the world, and we came through that. So I've learned along the way that anything can happen. There can be any change. It can be a geopolitical change. It can be a government change. There could be a government change in the U.S. This coming year. All these things have uncertain applications to it. And far be it from me. Like I'd be the first to say that don't take advice from me. I'm guessing. I'm throwing darts at this. But I do think there is still problematic inflation, just as all this money supply has to work through the system. And it's slow. Like think of all the people right now that have fixed mortgages. Someone in the US did a 30-year fixed mortgage. They're unconcerned about it. If they don't have any car payments or small car payments, maybe it's a bit of an inconvenience there, but it's not devastating. So there's a big portion of the population that's largely unaffected, or at least not to the state where it's causing panic. And then there is a section of the population which is going to feel a tremendous amount of pain through this. So how does a politician, how do the feds, how do they navigate through a good portion of the population doing really well, perhaps even better? There might even be people benefiting from this, whereas there's another section they could be facing financial ruin. That's way above my pay grade on how they have to make these decisions. But I don't see inflation as a whole, unless they start manipulating these numbers for political purposes or however they decide that they just need to shape this narrative. I don't see inflation coming down quickly. I still think that this is going to be a 2023 problem. Maybe we start seeing some signs of it late in this year going into 2024, but I think it's a problem as a whole, but it's not a problem that affects everybody equally.
So, as an industrial commercial real estate investor, based on your prediction, regardless of how confident you are, what are you doing as an investor based on this prediction that inflation is going to stay high, costs of goods and raw material, construction is going to stay high? What are you doing?
Well, within my existing portfolio, trying to get ahead of this. So we have one mortgage coming up this year. We have two mortgages coming up next year. we've already started talking to our lenders. Like, what does this actually look like? So we can start figuring out what our cash flow is going to be. And we're going to try to start renewing tenants a little bit higher to get ahead of this. And fortunately, we're industrials in a market where there is an appetite to get a little bit higher rental growth. So that's in the existing portfolio, trying to get ahead of it right now, because we have to assume that these interest rates are going to be where they are next year. And if they go down, fantastic. That's a win for us. But we don't want to be caught figuratively with our pants down, where all of a sudden now we've just eroded our cash flow. So we're trying to get ahead of it by getting some rental growth, trying to figure out what our cash flow is going to look like. And for anything new, I think you've got to go through that same exercise. Is there an opportunity? And when I say new to me, so it could be an older property, but it's new to me. What is the cash flow? What are the projections for cash flow? What are my interest rates going to be? And I still think that there's sellers out there that are cognizant of the current market conditions, that realize that the pricing isn't the same as it was a year ago. But I don't think you can pay last year prices for today's investment properties.
Oh, you can't even pay 3 months ago pricing.
No,
I mean,
you're right.
It's
absolutely
so
right.
dynamic because the rate has been changing every month. It just, unfortunately, it doesn't give time for sellers to catch up. So yeah, I think if you're in an industry, if you're in commercial real estate that relies on transaction volume, it's tough. It's definitely a hard time. But so you are still looking. I mean, I don't know. I don't want to spill too much of your portfolio, but with that recent stuff, you guys are still working out leases or figuring out costs and moving ahead?
I'm pretty comfortable actually with our whole portfolio. So
Okay.
everything that we have is Western Canada right now. But my preference going forward is I actually want to start going into value add industrial in the Sun Belt. I just
Yeah.
responded to a tweet on this. Actually, I think you liked it, from Moses. Where would you be going? That's where I'd be going. And like, in a simple investment thesis, value add industrial in the Sun Belt. And I'd stay away from blue states as well. I should have been another caveat that I put in there. I wouldn't do California or some of these blue states. But value add industrial. I think if you've got the ability to add value. And I interviewed Chris Powers the other day, who made a good point about this. Like, what is value add industrial? It can be an old owner that just hasn't put any attention to it. They've neglected their roof, or they've got gross leases that have been 20 years old. Any opportunity you have to actually go and increase the value of that property. And if you're doing it in a market where there's population growth, I think we could have a year or two of volatility. Like, that wouldn't surprise me. Even though industrial has been trending up, I wouldn't be surprised if we saw a downward trajectory for some period. But as a real estate investor, and I'm sure you're the same on this too, Ron, is that you've got to think long term. You can't be thinking, I'm going to keep this investment for a year and flip it. Maybe you can. That'd be a great exit strategy if the value spiked 50% for some reason. But I'm a long term holder. I'd like to hold real estate essentially forever. So these temporary aberrations, I wish I could reduce it to being just noise, because it is more prevalent than that. But in a 20-year trajectory, 2 years of disruption really is insignificant.
Yeah, I think that's a great way to look at it. I'll answer my own question. For me as a real estate, I think inflation is coming down. I think things are going to start to get under control. But in another way too, I still think that's going to unlock the economy in terms of demand for industrial space. It allows the tenants to kind of get their breath and kind of refocus on what they're doing without worrying about their costs, right? So they're a business too, with input costs and output. If their material costs can calm down, their supply chain calms down, they can now focus on growth and expansion and serving their customers at, a reasonable price. But that's where I'm at. And I think that, again, we're still looking. We're under contract on another 4-acre site here, but we're still buying if we can combine, it's got to be an attractive cap rate. So we can't buy with negative leverage, and then fixed debt. And to me, those are the two tools that allow you as an investor to weather the storm. Because if I was buying on 24-month or 12-month variable or IO, I'd be nervous, right? That's where there's a lot of stress that's leverage to implement your value add. But if I'm buying with fixed debt and I have the debt service on day one, month one, without lifting a finger, I feel good. And that's going to allow me to continue to buy because, again, some of these deals, you're getting a seller to adjust, and hopefully, they're adjusting down low enough that it makes sense on the yield. But locking up that dirt for the long term, I think, is really the goal. And using this turmoil, which is fair. I think sellers can have your perspective, and sellers can have my perspective. They're both valid, and they're both useful in different ways.
And that's really what makes a market. Is you could hear a whole bunch of people being skeptical about the market and thinking there's going to be a crash, and that's one side. But on the other side, there's going to be people that say this is a great opportunity to buy because this is a short-term effect. Every recession that I've been through has ended and it's come out the other way. So there's going to be people that are inherently much more optimistic, and there's going to be people that are inherently much more pessimistic. But that's what makes a market, whether it's a stock, whether it's real estate, whatever it is. You need to have people on both sides. So I think that we'll never really know until we have the ability to look back on this. Just right. Like we'll never really know what did the pandemic do to the supply chain, and then this huge run up in demand for warehouse space all over the world, and the corresponding amount of new construction and the rental rates that came from it. We can guess right now, and we could even look back on how much it's run up, but I think you need a longer term outlook to really appreciate what this is going to mean in like the global history of industrial real estate and just the market as a whole. But I still do think that there's storm clouds that are present. The office market looks very shaky to me. Retail at best is flat. I think industrial is strong. Multifamily, I think, is also going to be flat just because people only have so much money at the end of the day. And I think all that's going to drain the capital markets and put pressure on that. So I think it'll be difficult even financing industrial properties for the rest of this year. So I think inflation is still a much bigger problem than the media and the feds are allowing us to believe.
All right. Well, and I think inflation is getting under control. It is already dropping. And for some people that are not absorbing all of the increases of inflation, they're in a relatively good place. But that's it for today's, live.
One thing.
Oh yeah.
We should someone should write in the comments whether they're team Ron or team Chad.
All right.
Inflation
vote
up or inflation problem.
For whatever you think is going to happen. You're on team Chad, that inflation is going to continue to persist, or your team Ron, and the worst of inflation has already come and we're back down to 6%, 5%. I'm not going to claim we're at 2%, but I think we're past the worst. All right. Well, thanks for watching, guys. As always, smash that like button, smash the dislike button, subscribe if you're into more commercial real estate content.
And team Chad. #team Chad.
All right.